David Bahnsen, one stock you like over at the Bahnsen Group at HighTower is Procter Gamble. Those shares have really suffered this year, down over 20% due to FX worries and restructuring their brand portfolio. So why do you like it?
Well, part of the reason we like it is for that very reason. We came into it very recently. The 20% drop brought a lot of value back. We love the dividend yield, of course, but the forex issue you bring up is the big play. We think that the dollar has been strengthening for over a year. We don't believe that that same rate of strengthening continues, and always we think forex is a short-term phenomena. Ultimately, value trumps out. These are strong brand names. It's a highly defensive stock. We want it to sort of protect against broader macro risk. Procter Gamble is very well managed, and we think that it's a little pricey on a valuation basis, but overall, dividend yield, the price deterioration, we like Procter Gamble as a good defensive name in the consumer staples group.
Well, staying consumer staples, you also like Clorox. They've had a great year. They're up, I think, about 10%, even as the S&P has fallen this year. So why don't you talk about why you like this particular brand play?
Well, Clorox has a lot less forex exposure than some of the other consumer staples names, certainly less than Procter Gamble, so it hasn't been as affected short term. But we do believe that Clorox provides the same type of thing that Procter Gamble does in terms of brand leadership. It is not CapEx intensive. It doesn't rely on debt markets. So a lot of the big fears that people see, certainly China exposure, not a fear there. So we like what that group does. Those two names really just happen to be strong names in the sector that have provided a lot of defense for us in our client portfolios.
Well, let's talk about a different group, and that's the MLP sector. The pipeline players really have been hit hard so far this year. One of them that you like is Enterprise Products Partners. Has a nice yield, 6.5%, but the stock's down over 30% this year. What's it going to do to make it turn around?
Well, first of all, it's up 18% in the last 48 hours, which isn't a lot of consolation when it was down about 18% in the 48 hours before that. But they just announced their 45th consecutive quarterly dividend increase yesterday. The insiders who own 34% of the company are adding another $50 million. It's $200 million now that they've bought this year. This is not acting like a company that is in any need at all of cutting their dividend. You look at a chart of Enterprise, the dividend increase looks like this. All of a sudden, the chart of the stock has done that. That disconnect is extremely buyable. We do like the whole sector of midstream MLPs, but if we were to buy one name that really we think captures the value in the space, especially after this price deterioration, which we're the first to admit has been way worse than we would have expected, we think Enterprise is that. 130% distribution coverage, incredible balance sheet, a leadership name.
All right, well, let's stay in the sector. Plains All American, they pay, I think it's like a 10% yield. Is that yield safe? Because that stock also has fallen, that MLP, I should say.
And when Plains All American, one of the reasons you see a 10% yield is because the stock dropped so much after their last quarterly earnings, where management reaffirmed the present dividend but expressed concern about that growth of dividend. They have an extremely conservative management team. They've been through this cycle several times. To us, Plains All American has a great deal of balance sheet strength, great assets, and now an extremely compelling yield. They may not grow the dividend as aggressively as some of the other names in the space, but the dividend as it is now is very, very safe. One of the things we tell clients is if you can withstand price volatility, particularly after the worst of it that we've seen, at this point it almost is like a bond that is trading 7 to 10% as a coupon. So these have great names, and really you have to be ready for greater risk and volatility. The bond analogy falls apart there. But we don't believe these distributions, especially with those two names, are in any kind of jeopardy. And in fact, we think the price recovery will come around a number of catalysts.
All right, well, thanks a lot, David Bahnsen.
Thank you very much. Appreciate it.
And thank you for watching The Street.